find her.
I'll try that again. Good evening, ladies and gentlemen. Scared me. Welcome to the Polsky Practical Personal Enrichment Series. I'm Emily Fowler. Welcome and thanks for being here tonight. But before we get started, I'd like to request that you turn off all those noisemakers, phones, pagers, Blackberries, blueberries, crackberries, so we don't disturb everyone around us. Thank you. The Polsky Practical Personal Enrichment Series is underwritten by the Norman and Elaine Polsky Family Supporting Foundation within the Greater Kansas City Community Foundation in partnership with Johnson County Community College. It includes topics that are not being offered anywhere else, so we hope you learned something tonight that you didn't know when you came in. Local professionals often join us to benefit you with the knowledge that they have to share. Norman and Elaine Polsky's name graces this wonderful theater where a variety of programs happen all year long. So we want to thank them for their generosity, which also brings you the Polsky series. Norman and Elaine support organizations across Kansas City and the nation, enriching our community and communities around the world. And Norman, Elaine, thank you so much. Just a quick moment to acknowledge our TV crews and the Carlson Center production crews. Thank you for your help tonight. And now let's get into the packet that you were handed when you came in. We'd like you to take this home and share what you've learned tonight with your family, so let me take you through the contents very quickly. And I want to say thanks to Norm because we have a skinny packet tonight, so my job is going to be really easy. First of all, the two cards. First we have the blue question card. So if you have a question for Adam Bowl during tonight's program, please write it on the card, and one of our ushers or I will come by and pick these up as the program progresses. So if you think of something, write it down and you can hand it off to one of us. And then we'll start the Q&A about 30 minutes before the end of the program, about 8:30. Also, the green survey card allows you to give us your feedback, add yourself to the mailing list if you're not already on it, give us your email address so we can send you updates by email. We're looking for 100% return on these tonight, and believe me, Norman asks me, how many cards did we get? So let me say 100% of them came back. Thank you. Now behind the cards on pink is Norm's quarterly article showing his investment results, and on the back is his investment history. He wanted me to point out to you at the top of that page, the front side, his 3-month return. The S&P, for the last 3 months, the return was 25.8%. Norm's return on his own mutual funds was 39.9%. So if you too would like to receive this on a monthly or quarterly basis, Norm's address is there near the bottom of the front page, and you're welcome to send him 4 self-addressed stamped envelopes, and he will get the report to you whenever he has it coming out. On yellow is Norm's My Legacy to You, Achieving Financial Independence. First, some strategies from Jim Stowers of American Century Investments, but then 11 strategies from Norm Polsky for mutual fund investing. And on the back of the yellow sheet, Norm's 10 Commandments, which he originally shared with his alma mater, Purdue University. They asked him to come back and lecture as an old master. He shared his 10 Commandments, and then he says they never asked him back again. On the blue sheet is an overview of the stock market's performance over the past 50 years, 1957 to 2008. Norm wants me to remind you that the stock market is always seeking new highs, so don't lose hope. It will come back, folks. We just don't know when. Maybe our speaker tonight can clue us in on that. And on the back of that page, Norm's weighted scoring system that he uses to decide on which mutual funds to purchase. On the green sheet, information about kindness and an organization called Reaching Out from Within, started by one of our past Polsky series guests, Sue Ellen Freed, and supported by the Polskys as well. On purple, you'll find biography information on Norman and Elaine Polsky, as well as a list on the back of their 49 endowments which support organizations all over the world. And 2 things I'd like to remind you of tonight, and we're done with the packet, so you can put everything back in order as you'd like to have it for the program. First of all, we have a book for sale in the lobby. This is Adam Bold's brand new edition of The Bold Truth. This one is about investing. There are 100 books available tonight. A few of them have already been purchased. Our price is $10. This book is normally $15.95 in the bookstore. And a special treat for you, all of them are autographed tonight. So if you'd like to buy one while you're here, and get one for Dad, because Father's Day is coming up on Sunday. So take one of these home with you before you go home tonight. And secondly, our next program is September 2nd. It will feature Barnett Hellsberg with a program about entrepreneurship principles that are helpful for everyone. So keep your eyes open for the postcard on those programs coming up soon. You'll notice that tonight's program, as all of our programs, are being taped for broadcast on JCCC television. That's channel 17 on Time Warner and Shore West and channel 22 on Comcast. You can also watch the Polsky broadcasts online in its video.jccc.edu, and you can watch it 24/7. You can get up at 3 a.m., whatever you'd like to do. And on the left side of the program, there's a postcard for tonight's program. So if you'd like to look at that later, you can do so. So now, it's my pleasure to introduce tonight's speaker, the founder of the Mutual Fund Store, which he started in 1996. You probably know him as the host of the Mutual Fund Show, heard live in radio markets across the country and locally here in Kansas City on KMBZ 980 AM, Saturday mornings at 10 o'clock. And of course, he is the author of the book, The Bold Truth About Investing. And this edition just came out in April of this year, so very up-to-date information for you. So please welcome to the stage, Mr. Adam Bold.
Hi. Emily, how are you? I'm good, Adam. How are you? I am very well. First of all, thank you all for being here this evening. And before I get started, I do want to thank Norm and Elaine Polsky. I believe that with privilege comes responsibility. And there are a few people in this world who have served as mentors and role models for me. Mr. K, for example, was one of those. Norm and Elaine Polsky are those kind of people too. And the people they've helped it's amazing. They've done a fantastic job, and it's really my privilege not only to be here this evening, but to have gotten to know Norm and Elaine personally. In fact, Norm, by the way, I will say this, for those of you who don't know Norm is one of a kind. When Norm was born, God said, I ain't going to do that again. It was in a good way. And just to give you an idea, Norm passes out these flashlights all the time. This one has both Norm and Elaine on it. The one I like, and I have the whole collection, but the one I like has just Norm's picture on it, and it says, "Squeeze me." Which I like very much. So once again, thank you, Norm and Elaine, for having me tonight. So here we are. Everybody had a good year? Nah, maybe not so much. So let me start with this story. It's about these two women that are taking a leisurely walk near this pond, and they come upon a frog, and the frog says, "Hey, ladies," because that's what frogs say, no, right? No. So, "Hey, ladies," and they look down, it's a frog. "Hey, ladies, come here, pick me up." So the lady reaches down, she picks up this frog, and the frog says, "Hey, I am not really a frog. This witch put a spell on me, and as it turns out, really, I am a stockbroker. And if you give me a kiss, I will turn back into my normal shape." And the lady thinks about it for a minute, and she takes the frog and she sticks it in her purse. And her friend goes, "Hey, didn't you hear the frog? He just said if you kiss him, he'll turn into a stockbroker." And the other one goes, "Yeah, but these days a talking frog's worth a lot more than a stockbroker." All right, here we go. Let's talk, shall we? Here's my agenda for this evening. little thing I call rebuilding your personal wealth. Actually, when Norm asked me to do to speak again this year, he was like, well, just take your book and talk about your 10 commandments and about building wealth. And then as time progressed, it turns out we had to retitle it, rebuilding your personal wealth. So 5 topics. Don't base your future investment plans on 2008. Asset allocation is essential. Market timing is impossible. Only invest in what you understand. And how do we go about picking funds now in today's environment? All right, don't base your investment plans on 2008. Let me talk about this just in concept for a moment. 2008 was perhaps the worst year ever in terms of investment. And the reason I say that is it came out of, we had just rebuilt out of the bear market of 2000 through 2002. We finally get even, and then boom, surprise, here comes this terrible destruction of wealth that happened in 2008. And kind of came out of left field. It happened really, really fast. Many of you who listen to the radio show may have heard me use this analogy before, but I'm going to use it tonight. It's sort of like, it's sort of like women and hair removal. And I know that sounds bizarre, and you're like, well, all right. And I know the people that work with me are like, all right, what's going to come out of his mouth right now? Here's what I'm talking about. Okay, I know that women shave their legs on a regular basis. I complain about having to shave my face, which is a pain. But you can shave your legs. Another thing you could do is you could have them waxed, right? And it hurts, but boom, it's over. Or you could take a pair of tweezers and pluck them out one by one. Well, the bear market that we had from 2000 through 2002, that was like plucking them out one by one. The thing lasted for 3 years. This was like the wax, boom. Like every day, people would come up to me at a restaurant or at my country club, and they would go, hey, Adam, I bet you're not sleeping so well these days. And I would go, no, really, I'm sleeping like a baby. And they go, really? With like the market every day you wake up and the market's down more, you're sleeping like a baby? And I was like, yeah. I sleep for 2 hours and I wake up crying. And, and it takes me another 2 hours to try and go to sleep. And so, but here's what happened. Because 2008 was so terrible, and because it happened so fast, and because it happened close to the bear market of 2000 through 2002, people have been psychologically affected by 2008 in a way that they weren't affected by it's like, oh no, I can't do this again. And the best analogy that I can use is I compare it to my grandmother, who actually, she lives in Rochester, New York. She's not here. On the radio, I sometimes tell this story, and she gets me, she's like, don't tell people how old I am, but she's 94 years old, and she grew up in the Depression, and then she got married, and then my grandfather went off to fight in World War II. Okay, so she grew up in this era where, people talk about, oh, we're making all these sacrifices for the war. I'm just going to tell you right now, both of my grandfathers, Norm, people who the American public made sacrifices during World War II that were unlike anything that we've seen. You get meat once a week, you get sugar once a month, whatever it is. My grandma, 94 years old, she's doing just fine financially. She's not rich, but she's got enough to live the rest of her life. We go out to lunch, and she takes sugar packets, and she sticks them in her purse. Now, my grandmother knows that she can go to the store anytime she wants and buy sugar. She knows that there are lots of places she can go to get sugar. But there's something psychologically in her brain from when she was young and when she went through the Depression, when she went through World War II, it was so traumatic that it affected her psyche forever that she's like, if you ever have a chance to get sugar, you should. okay? And I don't know what in the heck she does with all the sugar packets, but it's an irrational psychological reaction. And the same thing is happening to people right now because of what happened in 2008. What are the results? Some investors, many investors, are making their investment decisions in the rearview mirror. People are going, oh, I want something that is guaranteed. And so the insurance companies, the annuity companies, they are making hay right now and selling things. And what they do is, the way they pitch these products is they go, hey, here's the deal. You buy this thing, if the market goes up, you benefit. If the market goes down, you're guaranteed to make at least this much. That's their pitch. Or they go, this guarantees that you'll get 10% forever. And that's their pitch. Well, then all of these products come with a prospectus that's about 500 pages thick. And, you know, I'm going to guess maybe the devil is in the details, and we'll talk about that a little bit longer. Treasuries. If there is a bubble, what happened last year, credit markets froze up, stock market's plunging, real estate's plunging, oil's plunging, all the places that people had ordinarily looked for safe havens in the market, all of a sudden everything went down at the same time. That's why I call 2008 a perfect storm, other than treasuries. And what happened was the price of U.S. Treasury bonds got artificially high. And the reason was that there was a lot of demand and there was limited supply, and so prices went higher. Now what we have is just the opposite, and that is people are starting to realize, all right, the stock market will come back eventually. The economy in this country will come back eventually. Maybe I should start taking more risk. I'm starting to see some returns from stocks, from bonds that are more normalized, and I want to participate in that. And at the exact same moment that that's going on, you've got the United States Treasury, because of the TARP, you know, this plan, this program, whatever, the U.S. Treasury is borrowing a ton of money. So now all of a sudden, you've got a lot of supply and limited demand. That's going to push Treasury prices down. And there's a lot of people who don't know that they can lose money in Treasury bonds. Now, ultimately, if you hold them till maturity, you won't lose money. And I'll tell you right now, I know there are people on the radio, people talking about how this country is going to go bankrupt, how this country is going to lose its AAA rating on its bonds. That's not going to happen. The U.S. Treasury will be there and will be there to pay off their bonds, but they're borrowing a heck of a lot of money, a lot of supply, not that much demand. We're going to see prices go down. Moving to cash. A lot of people, and I get the calls to the radio show, I talk to people, and they're like, we got to February, the end of February, and they're like, I can't take it anymore. I got to get out. I'm going to put it all in cash. And of course, that was exactly when the market started turning back up. And you know, I'll just remind you that with your investments, and I'll talk about this in a little more detail later, but it doesn't have to be an all or nothing proposition. There are some middle grounds that you can take. Gold. Hear these guys on the radio? You know, buy gold. Gold is, you know, gold has never been worth zero. These people will buy your gold. Cashforgold.com. You know, let's just put it this way. Not a good place to be. Last year was the perfect storm. Everything went down. Everything went down except for U.S. Treasury bonds. And what you have to, when I'm asking you, you don't have to, I can't make you do anything. What I'm asking you to do is to consider this, and that is that right now, from this day forward, forgetting what's happened in 2008 and the first couple months of 2009, we are much more likely for the next decade to have a more normalized market environment. And how do I know this? What are the signs that I'm seeing? I'm seeing things like bonds. And what is a bond, by the way? A bond is a loan. You're giving a loan to the federal government if it's a treasury, to a corporation if it's a corporate bond, et cetera. It's just a loan. bonds are now starting to be valued on whether or not the issuer of that bond will be able to pay the interest and ultimately pay back the principal. That wasn't the case last year. We were in a situation last year where bonds were just like, if it's not from the Treasury, I don't want it. Stocks, we're starting to hear things like the earnings of this company are likely to be this. We're starting to listen to the commentaries that the executives of these companies are making about the future, the outlook for these various companies. And that's the way the stock market is supposed to work. That's not what happened last year. I contend that we are back to an environment where we're normalcy. We can expect normal kinds of stock market movements to the upside, to the downside, not the kind of thing that we saw last year. And if you make your future plans based on what happened last year, I think you're setting yourself up for some bad situations. Asset allocation is essential. Now, asset allocation, we investment guys, we throw that term out all the time. All it means is how your money is split between different types of investments. And one of the things that we've learned is that the market goes through cycles. Sometimes they like stocks, sometimes they like bonds, sometimes they like treasuries, sometimes they like real estate, sometimes they like big company stocks, technology stocks, international stocks, etc. Here is a chart, a graph, chart, graph. I'll go with the graph, chart. And you guys back there, you can't read all the writing on here, so let's pay attention to the colors. What this shows is from 1999 through 2008. The various asset classes that we track ranked from the best performing at the top and the worst performing at the bottom. So if you notice, we have a year like 2000, 2001, where the light blue, let's see, what was the word? There was a crayon that color. I can't remember what it was. Pardon me? Yeah, all right. These colors down at the bottom, look, the black ones up at the top, and then all of a sudden the market comes back, 2003, 2004, the black ones move up here, down here, the blue ones move up there, the pink ones move up, and so just as soon as you think you've got the pattern figured out, then it goes the other way. Then we have 2005, 2006, 2007, that blue box at the top is international stock. Those blue boxes at the top are international stocks. Boom, best performing. Okay, I got this figured out. All I got to do is take all my money and put it in the blue stuff. Oops. Okay, and the same thing is happening in reverse right now as the markets begin to come back. What we want to do is we want to spread our money between all the colors. And one of the things that we have learned throughout this whole thing is that part of asset allocation includes money market. Having some cash reserves is not a bad thing. And that's fine. But once again, if you have confidence, if you have true confidence in your asset allocation, in how you have things split, you can weather just about any kind of market environment. Now, let me illustrate what it is that I'm talking about with true confidence. And I'm going to use sports here. Many of you may know I'm a big sports fan, and I particularly love the game of baseball. And I go to a lot of baseball games. I love baseball. It's a thinking person's game. It's a very entertaining game because there's a pitch, and then you talk about it. And then there's another pitch, and you talk about it. And, you know, football's like, I love football, don't get me wrong, but it's like boom, 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 right in your face. Baseball's a pitch. Hey, let's talk about it. And I remember when my girls, who are all, I live in a house now with 3 teenage girls, I was at a swim meet last Wednesday, and this guy came up to me, he's my age, and he goes, he was at a swim meet like 10 years earlier, and he goes, he met this guy who had teenage girls, And the guy said to me, he goes, I hate my daughters. And he goes, I remember thinking, that guy's a jerk. He goes, I can't understand why anybody would, I love my daughters, they're sweet. Why would anybody ever say that about their daughters? And he goes, I hate my daughters. So it's funny how it comes around. I took my daughter, but here's the point, which I lost for a moment there. Baseball, I remember sitting there talking to my girls, they were little, and trying to explain the concept of a sacrifice fly. You know, in football, you either make positive yardage or you don't. In baseball, okay, wait, so the guy was out, but it was still good? Yeah, because he advanced the runner. It's a complicated, it's a great game. One of the things about baseball is the curveball. A curveball is an amazing thing. Let's see if I can make this work. Let's watch a curveball here. Okay. Pitcher, curve. Okay, now, here's the thing about a curveball. A curveball, when it leaves the pitcher's hands, is head high. And then between the pitcher and his home plate, 60 feet, 6 inches. So what happens with a curveball is for 57 feet, the ball is head high, and then in the last 3 feet, it drops down in the strike zone. Just to illustrate that, look at this. This is about 6 feet out. That's this video that I just showed you. 6 feet out, that's where it is. Right over the plate, boom, that's where it is. Now, hitting a curveball, therefore, is a very difficult thing because the batter has to make a decision as to whether he is going to swing the bat or not, while the ball is nowhere near where he can hit it. Okay, so what happens, the way that a person learns to hit a curveball is they'll watch things like the rotation of the ball. I've even had hitters tell me that they can watch the movement of the pitcher's fingers, and they can at the moment that the pitcher releases that ball, they can tell what the pitch is going to be. But they have to decide whether they're going to swing or not when the ball is way out of the strike zone. Okay, but a major league hitter, a guy who can hit a curveball, knows with his heart and with his soul that if it's a curveball, that when he swings and he comes through by home plate, that the ball is going to be in the strike zone. So he's going to, if the pitch looks right, he's going to swing, even though his eyes tell him the ball is not in the strike zone. He knows that when the bat gets there, that it will be in the strike zone. He absolutely believes with all his heart and soul that the ball will be there. Well, if your asset allocation is the right way, is set right for you, for where you are in life, for your risk tolerance, etc., then even when the market throws us a curveball, you can wait it out because you know eventually that ball is going to drop right into the strike zone. Sometimes that requires patience. Once again, being fully invested does not mean that you don't have money market. Okay? One of the things that I've learned, one of the things that we're doing differently in today's world than we were 5 years ago, 10 years ago, is that our more conservative allocations have more cash. Because what we don't want to have to do is we don't want to have to sell things in a down market. We want to be able to wait out the bad market, and we don't want to have to dig into principal during that market. By the way, people go, well, asset allocation didn't work in 2008 because bonds lost money. Unless you had bond funds lost money last year too. Well, yeah, bond funds lost money, but they lost substantially less than stock funds. So it didn't really seem that cool because bond funds went down a lot more than people had ever anticipated that a bond fund could. But still, it did work, and that is that the portion that you had in bonds lost less than what the stock funds did. Regular rebalancing. One of the things that we do for all of our clients is regular rebalancing, and if you're doing it on your own, you need to do rebalancing too. What does that mean? That means that if you start out just for the sake of discussion, and you had half your money in a stock fund and half your money in a bond fund, over time, those those percentages will get out of kilter. And what we need to do is we need from time to time to put them back to our ideal composition. And by doing that, what it does is it forces you to take money out of things that have already run up, which is hard to do. You know, when things are going up, you're like, yay, I'm going to just put all my money in this thing that's going up. It forces you to take profits in things that have already gone up and put it into things that are lower, and vice versa. And rebalancing helps. And lastly, I'll just say, if the declines in your account values in 2008 and into the beginning of this year were more than you can handle. Now, I'm not saying, I want to be very clear here. I'm not saying if it was as much as you can handle or nearly as much as you can. Last year was the perfect storm. It was the most pain, the most, however strong your risk tolerance is. Last year pushed the bounds of all that. But if it was more than you can handle, that meant that the allocation wasn't right going in, and you need to adjust it now. Market timing is impossible. We're going to play a little game tonight. This is called the What Would You Do game. Okay, so here is A. And what this is it's not important what the security is, but this is an actual thing, an actual chart of an actual market performance. Now here's my question. Okay, you're here, you're going, all right, this is cool, everything's going up. When you get to the end of the chart, the right side of that chart, what do? We're going to try and time the market here. Okay? Clearly, during this period of time, other than a slight hiccup about 2/3 of the way through, this thing just does nothing but go up. So here's what I'd like you to do. This is chart A. Just mental it, make a note. What would you do if you were going to try and time the market, this security? What would you do at the right edge of A? Here's B. Same question. What would you do? Here you are. Okay, so clearly this stinks, right? Nothing good's going on here. So during this period of time, B, what would you do? Now we're at the right edge. What would you do? Okay, so now you've got to think and remember, what would I do at A? What would I do at B? Here's D. Just kidding. C. Here is C. Yeah, that's not bad. Kind of nice, steady, going up. All right, so now what do you do at the end of C? All right, everybody got their decisions made? Let's look at it. As it turns out, A is the S&P 500, a measure of the overall stock market between January 1, 1995 and August 31st of 2000. And what you see is that the S&P went from, 450 up to 1450 during that period of time. Remember I asked you about A, what would you do? B, this is the S&P from the next day. Okay, this starts with the end of chart A and is the S&P from 2000 through 2003. C is the next piece of the puzzle, and when you look at them all together, this is what you get. It turns out that A, B, and C, it's the same security. It's the same thing. Now, I can imagine, human nature being what it is, that when you're at the end of A, you're going, cool, this is great. The market does nothing but go up. And in B, we were down at the right side of B. You're going, all right, I should get out because the market does nothing but go down. And then C, what we had there was a full recovery between 2003 and 2007 of everything we had lost during B. All right, want to play again? I say yes. Okay. Here we go. Chart, actual security, chart number 1. What would you do? Right there. What do you do? You think you know. Adam, you're well, let me ask you a question. That actually isn't the end of 1. There. That's the end. Oops. Because right here, you might have gone, okay, he's tricking me again. This was the bottom. Okay, so now here's my question for you. At the end of 1, what do you do? Going to try and time the market. Clearly, nothing good is going on here. How about chart 2? It's pretty good. What do you do now? The right edge of chart 2. Okay, guys made your decisions? Okay, that's a good question, and the reason being is this is the market that we had from January 1 of 2008 through March 9th of 2009. This is what's happened since March 9th through June 9th, and these are the two together. So I would, if you're trying to time the market, my question is, really, the really important question is, what do you do at the end of 2? Because that's right now. See, one of the things that we have to know about market timing, people will come up to me and they'll go, well, Adam, why didn't you take all of your clients to cash before the bear market of 2008 into 2009? Clearly, we were going into a horrible market. You know what the problem is? Nobody knows what the rest of the chart looks like until later. You don't know. I mean, I can tell you that on March 9th, 2009, that's when I was sleeping like a baby. Yeah. It was a terrible time. And I mean, gut-wrenching. Like I said, it pushed the bounds of what any of us could accept. Norm gave you a chart that shows the performance of the U.S. stock market between 1957 and now. Is that right? 57? Yeah. We're going to have these things. Now, I know that having 2000 through 2002, and then boom, just when we thought it was safe, 2008 came along. I will just tell you that you can't time the market. From time to time, we're going to have these things. Unfortunately, we had 2 100-year floods within a 5-year period. Can't time the market. You've got to be patient. Just some statistical data. This is from Ned Davis Research. Using returns of the stocks comprising the S&P 500 index, that they found that $1,000 invested on January 1, 1988 would have grown over 20 years to $8,860 if it was invested the whole time. Okay? Just put your money in, forget about it for 10 years, or 20 years, it grew 8-fold. If you missed only the 5 best days out of that, 5 days out of 20, because you were trying to time the market, instead you end up with $6,800. If you miss the top 15 days, that's really, I mean, 15 days out of 20 years, you've got $4,500. And if you miss the 25 days, you're at $3,300. You're talking about 62% less return if you missed 25 days out of 20 years. Now, I know it's no fun. If we're talking about entertainment value, if we're talking about personal satisfaction, if we're talking about the wealth effect, about how we feel internally, it's no fun going through these times when the market is like 2008. But you have to be patient. It will work itself out. And, you know, we live in a world now where nobody wants to wait for anything. We've become the most impatient society in the history of the universe. We want, well, let's face it, our ancestors had to either grow or kill their food. We don't want our food unless they push it through a window so we don't have to get out of the car. I remember in the old days, like 5 years ago, I used to go, I have to go home and check my email. I have to go to the office and check my email. No, it's right here, okay? I don't want to wait for email. And not only does this device have my email on it, and can I make phone calls, but I got my Facebook page on there, I got texting, I got boom, 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 boom. I don't want to wait for anything. I want it right now. This country has become extremely impatient. And I wish that investing was like that. I wish investing was like the kind of thing where you have your, you put this out there, and then like the next day it's good. And that's what's happening. People are like, well, I put money in this mutual fund, and I've had it there for a year, and it hasn't been very good. Well, you know, a year, it takes time, but it will work out in the end. By the time you figure out the pattern, oh, wait a minute, I just realized the market is going down, it's just going to keep going down, there's nothing but bad news. By the time you figure it out, it's probably too late. By the time that we knew we were in a horrible bear market, things turned around. By the time that people realize that we're back to a normalized stock market, they've already missed out 35% recovery in the market. Things come back. Only invest in what you understand. You guys heard of CDOs? Collateralized debt obligations. You know, a CDO is a portfolio of subprime mortgages. And the beautiful part about subprime mortgages is, see, like a regular mortgage, 5%, 5.5%, 6%, subprime mortgage, 9%. So if you own that mortgage, you go, this is a sweet deal. Instead of getting a 5% return on my money that I put out to be invested in the housing market, I'm getting 9%. And so these guys at Bear Stearns, they were really smart. 150-year-old firm, beautiful. They go, okay, we're instead of buying normal mortgages where people have to do crazy, wacky things like make enough money to make the payments and have some down payment and have had a job for a while and, oh, let's verify their income. You don't, you know, I make $8 million a year, yeah. People could write down whatever they want. Instead of doing that, we'll just, you know, we won't do. And so they did that, and it was a beautiful thing. They made these mortgages, people made their payments, the houses kept going up in value, people sold the houses, the investors got their money back, and then some brilliant guy said, you know, instead of just getting 9% on our money, we could borrow money at like 3%, and we could lend it out at 9% and leverage our returns, and we'd make even more. And it was a beautiful thing, and they made a lot of money. And then, well, you know, instead of like 2 times borrowing, if we did 10 times borrowing, we'd make even more money. Okay, cool. And things went along, and it was a beautiful world, and they were making lots of money. When Bear Stearns went out of business, their portfolios of CDOs were leveraged 30 to 1. Okay? You wonder why Bear Stearns went out of business so fast? It was because they got a margin call. And when you're leveraged 30 to 1, you're in big trouble. You got to sell something, and they didn't have anything to sell. And that's what started the whole cascade. Now, here's my question. Who needed to own CDOs? Who needed to own a portfolio of subprime mortgages? Nobody I can think of. ARPS, auction rate preferred securities. Auction rate preferred securities were these things that were sold by the major brokerage houses, and they were leveraged products, and what happened was they sold them as a money market alternative, and they said you can put your money into this deal and you're going to get a much higher rate than what you get in a money market account, but instead of having daily liquidity the way you do with a money market account, you'll have weekly liquidity. Every Friday there'll be an auction, and you can get, whenever you want to sell, you can sell. Well, when we had the credit meltdown in September, October last year, the auctions started to fail. And throughout most of the fourth quarter of 2008, these auctions failed, and people who had their money in these things stopped getting paid interest, and they couldn't get their money out at any price. And the amazing part about, like, I would hear stories about people who were, they had built a house, and they had their final payment that was due, and it was tied up in these auction rate preferred securities. They couldn't get their money out, and they were going to lose their house. Companies that had their liquidity, they were going to make payroll out of the money on Friday when they had the auction. No auction. Now here's my question. Who needed to own auction rate preferred securities? Nobody. That's who. Credit default swaps. Anybody know what yeah, you guys know what a credit default, let me tell you what, in simple terms, what a credit default swap is. This is what brought AIG down. This is why the government owns AIG right now. They went, you get these people, and they would go, okay, General Motors wants to build a new plant, but General Motors is kind of dicey. I don't know if we should really loan them the money. And AIG said, well, how about this? You guys loan General Motors the money, and you pay us a premium. It's like insurance, and if General Motors goes out of business, we'll make good on the bonds. So it's like life insurance for the money that you're loaning to a company. And that was cool. But then some people went, well, I don't think General Motors is a very good company, so what I'm going to do, and in this case it was Bear Stearns, Lehman Brothers, what I'm going to do is I'm just going to go buy the insurance even though I'm not really lending any money to these people. And AIG went, well, that's cool. As long as you pay the premium, it's all good. Well, then, guess what? Bear Stearns goes out of business, Lehman Brothers goes out of business, and now AIG has, AIG, their insurance part, they're doing just fine. The life insurance, the car insurance, all that, that's great. It's the credit default swaps that brought the whole company down. Now, here's my question. Who needed to own credit default swaps? Nobody. Hedge funds. That was a big, during the bear market of 2000 through 2002, hedge funds, some hedge funds, many hedge funds made money even though the stock market was going down, and people went, oh, I want that thing that goes up when the market goes down. That would be a really cool thing to have. Well, guess what? The hedge funds got their clocks cleaned. There's about, I don't know, probably 30% less hedge funds today than there were a year ago today. Who needed to own those? Nobody. Bernie Madoff. God love the guy. Not. This guy, okay, goes around, tells people, okay, here's the deal. You give me your money, and we'll pay you 2% every month, no matter what the market's doing. Good times, bad times, high interest rates, low interest rates. The return is exactly the same every single time, 2% every month. And some people went, well, how do you do that? And he goes, well, I got this thing. It's this cool thing, and I could tell you, but you really wouldn't get it. So, you know, just trust me. Like, talk to him. He'll tell you. It's cool. And that's what happened. And you know what? If you're going to ask me all these questions, I'm just not going to let you invest with me. So, hey, Bernie, whoa, come back. Don't. I want to do this. Who needed to be invested with Bernie Madoff? Nobody. Guaranteed annuity products. I talked earlier about these annuities and how they come with a 500-page prospectus. And we have 3 major life insurance companies in this country who would have gone bankrupt if the U.S. government had not bailed them out. Now, I will draw a very strong the original TARP plan, I'm a big fan. We're going to take these big investment banks owned securities that had value, but they just couldn't sell them right then. They weren't liquid. It would be like, it's the best example I can give you. You have your house. I say, you need to sell your house. How much do you think it's worth? And I'll give you 6 months to a year to sell it. That's one number. Now, here's another question. You need to sell your house, and you have to sell it tonight for cash. Banks are closed. It's got to be somebody's got some cash in their safe, right? It's got to be, I mean, you're going to get a completely different price. And the price that you would get if you had to sell your house tonight, you'd go, no, I'm not going to take that. Well, that's what happened. These companies had securities that have value. The house has a value. It's just they couldn't sell them right then. So the government comes in and says, okay, here's what we'll do. We'll put up some money, and that'll give us time to sell these things in an orderly fashion over an extended period of time. I don't like it, but that's what we needed at the time. We have 3 major life insurance companies where the federal government has just given them money so that they didn't go bankrupt. I'm like, okay, this is the land of opportunity. I love this country with every fiber of my being. I started a company in 1996, me and my assistant, in the basement of a little office building on College Boulevard. We've got offices in 70 cities, and I've got a nationally syndicated radio show. Tell me what other country that could happen in. We manage money for 28,000 people from coast to coast and border to border. Tell me what other country that could happen. None. Guess what? If I had made bad decisions, instead of Chris Broaddus, the president of my company, raise your hand. If I'd hired a moron, a bigger moron, no, just kidding. And we had made bad decisions, the company would go out. This country does not guarantee success. This company guarantees the opportunity for success. Now all of a sudden the government's just giving money to companies where they have a good business plan, bad business plan, it doesn't matter. These guys, you know what, the reason these life insurance companies are on the verge of bankruptcy is because they sold these annuity products. And they said, okay, here's the deal. You put the money in, if the market goes up, you get the benefit. If the market goes down, we will guarantee you can't lose money. Well, that was a really sweet deal until the market went down 50%. And guess what? They have to start making good on their guarantees, and they don't have enough money to do it. They didn't have enough time. Nobody expected the perfect storm like we had last year. And you know, my question is, these companies that are selling these things now, they're hoping, they're planning on everything going great from this point forward. But what if it doesn't? The devil's in the details. If those companies go bankrupt, then those guarantees that they've given on the annuity products are no good. Those products are guaranteed not by the full faith and credit of the United States government. They're guaranteed by Hartford Financial Group. And you know, people hear those names and they go, oh, well, Hartford, yeah, that's a 150-year-old company. Yeah, Bear Stearns was a 200-year-old company. Lehman Brothers, 150 years old. Okay, just because the name, I mean, let's face it. I hate to do this to myself because this has been a heartbreaking year for me. But George Brett don't play for the Royals anymore. You know, just because the team is called the Royals doesn't mean it's the same as it was in 1985. The same thing is true here. Just because there's a company that you know the name, you've heard the name for years, that doesn't mean it's the same company that it was back then. Past performance is no guarantee of future performance. The SEC makes me write that on everything that we put out. Yeah, it is no guarantee, but it's a darn good indicator. And people chase performance. Anything that can go up 80 or 100% in a year. An emerging markets fund, a gold fund, a technology fund, an oil fund, anything that can go up 80 or 100% in a year. China fund, forgot that one, can go down just as much. And if somebody presents you with an idea that sounds too good to be true, 2% a month, no matter what, run away. If it's too good to be true, it is too good to be true. Picking funds now. Let me just go through some very simple things. What we've been doing at the mutual fund store, what I've spent a great portion of my time doing recently, is trying to determine if because really good funds did very poorly last year. And here's the question. Was that because the fund manager has gone bad, or is it because a good fund manager had a bad year? And that's question number one you have to ask. Were my results poor because I had a poor fund manager who's not good, or was it just a good manager who's had a bad year? Step one. Step two, how do you know if the manager is now on track? Okay, well, the way you have to measure that is you have to start looking at things. See, Morningstar, we've got, and Yahoo Finance, and we've gotten used to the computers and all this stuff, but they track like 1 year, 3 year, 5 year. You got to go back to March 9th. Let's see, how has the manager been doing since March 9th? How has the manager recovered since the market started going back up? Are you getting all the upside as the market recovers? There are a lot of funds out there that had good 2008s, but have had poor 2000. There's a lot of fund managers out there who do well in down markets, but don't do very well in up markets. And the important thing that we have to look at is if you look at average returns. See, what a lot of people do is they go and they get out Morningstar, or they look on the computer and they look for the fund that has like the best 5-year record, the best 3-year record. Well, last year was so bad that it distorted the returns, the average returns. Let me show you what I'm talking about. Now, I realize you can't all see all the numbers, so I'm going to describe to you what you see. And I'm not even going to tell you, this is a real mutual fund. It doesn't matter what it is because I'm using it for illustrative purposes. If you look, this fund over the last 1 year is down 36%. Oh, yay. Give me the fund that loses 36%. No. Okay, well, let's see how it's done over the 3 years. It's averaged a loss of 7.4%. I want to own that. Over the last 5 years, 3.6%. 3.6, I could get that in a money market account. See, what's happened is last year was so bad that it distorted the average returns. I contend you can't look at the average returns anymore because you're going to be carrying around that it'd be like a baseball hitter, a guy who struck out every at-bat for a whole season. And then, because he had a broken arm, but they still let him play. It's a ridiculous analogy, but let's just say that happened. Okay, great. Well, it makes the averages look terrible. But if you look at this fund, what we have to do is look at the calendar years. Because what you see is in 2002, this fund beat the S&P 500 by 17.5%. In 1 year, by 17. In 2003, he beat the market by 19%. In 2004, he beat it by 10%. In 2005, by 11%. 2006, by 12%. 15% in 2007. And then, dang it, he lost 53% in 2008. Terrible. Worse than the market, horrible. And then so far in 2009, up 18.3% year to date, which is 16% better than the market. That's through yesterday. He's picked up 16. All right, this is a manager who consistently beats the market. He had a terrible year last year, worse than a lot of other managers. But he's making it up a lot faster, and he's somebody who, for the last 8 years, has beat the market by double digits every single year, except for last. But if you just look at the averages, it doesn't look that good. Once again, you can't, 2008 is going to distort the returns. You can't look at those anymore. All right, with that, I would like to invite Emily. Oh, did I mention, while Emily comes up here, my book? The thing that's great about this book is the handsome man on the cover. I like him. Come on, shall we?
Yeah, I'm turning on my light.
Excellent. Where would you like to sit?
I'll sit here.
Okay, I'll sit over here.
Hey, we didn't work this out beforehand, in case you wondered. Okay, how are you?
I am well.
It's
Is this going to be like the inside the actor's studio? Like, what word do you really hate? What word do you really like?
Oh yeah, what word has a sound
If you
that you
could be
love?
a flower, what would it be?
Just don't tell us what swear word you like the best. Or maybe later.
Okay.
But not, this is a family program.
Got it.
Okay. Well, we've got some very good questions tonight, and a couple of themes emerged as I looked through these. The first of them is about inflation. I've got at least 5 cards here, one from our wonderful benefactor who asks about, isn't inflation just going to be the thing to worry about from here on out? What do you think about that?
All right, here's what I'm going to tell you. This is probably the most frequent question that I get now. People were, and part of this is stirred up by the talk radio people. Now,
Would that be you?
No,
Those other talk radio people.
Well, but here's what you have to understand. I mean, all joking aside, a lot of people in this room came to know me from talk radio. Okay? And that means that by demographic, there are people who listen to talk radio. And if they listen to KMBZ, you've got Glenn Beck, and you've got Rush Limbaugh, and these people who are fanning the flames. And I will tell you this. Here's what I know. Inflation is a rise in the price of goods and services, right? Okay, well, first of all, right now they released inflation numbers today, and inflation's at 1.3%. And that's no big deal. Okay, now what people are assuming is that because the federal government is borrowing so much money, because they are spending so much money, that there's a direct correlation, and that ultimately we're going to have out of control inflation. Well, I'll tell you, there's a couple reasons why I don't believe that to be the case, and then I'll tell you what happens even if it does. Number one, a lot of this money that has been given, that the government has been passing out to banks, the money has not gone into the system. And what I mean by that is they've given money to banks to shore up their balance sheets, but they're not loaning the money out. Right now, it's pretty tough to get. You want to buy real estate, tough to get a loan. You want a business loan, tough to get a loan. The banks are hoarding this money. So ordinarily, when the government puts money into the banks, they loan it out and it goes out into the world. Right now, that money is still sitting within the banking system, and now we've seen some of the banks starting to pay that money back. The second thing is that inflation is not a sneaky thing. You can wake up, you can go to bed one night, and when you wake up in the morning, you flip on CNBC, the market's down 200 points. Surprise, the market's down 200 points. Okay? Inflation is not the kind of thing where you go to bed one night and it's at 2%, and then you wake up in the morning and you go, surprise, it's 10%. It doesn't happen that way. It goes 2, and then it's 2.5, and it's 3, and it's 3.5. Well, we may have higher inflation down the road. That could happen. It is a possible outcome, maybe even a likely outcome. But when that happens, we're going to have a lot of time along the way to begin adjusting to it. And I'll point this out. Is there anybody in this room, rhetorical question, there's nobody in this room who has not heard that inflation might be a problem down the road? Is anybody shocked or surprised by that? No. Okay, well, the managers that run these mutual funds that we own for our clients, they heard it too. They're thinking about it too, and so they are watching inflation as carefully as possible. I can tell you that Stacy Schreff, the Director of Investment Strategy at the Mutual Fund Store, myself, we're paying very close attention and watching the rate of inflation, but for the time being, it's not an issue. And what's going to happen is people are going to be scared into doing things that they wouldn't ordinarily do because inflation might come sometime down the road. If and when it rears its ugly head, we're going to be able to deal with it, and we'll have plenty of time to do so.
So it's kind of like you're timing the market. It's pretty impossible to decide when
Well,
inflation is going to become a problem.
if inflation does start showing itself, then we're going to make changes to the portfolio. And the fund managers that you can own one fund, and today they're positioned one way, and we start to see inflation, they'll sell all the stocks they have that would be hurt by inflation and buy stocks that will be helped by inflation. Okay, in the same fund. You don't have to sell the fund. The manager is doing that work for you. That's the beauty of active management. But it's not, right now, it's not a problem. Until this economy starts coming back, nobody has pricing power. I mean, we've seen oil prices go back up. Other than that, I don't see the store. You go to Oak Park Mall, they're busy again. That's good. I like the fact that people are out buying stuff again. But people aren't buying stuff unless it's cheap. Unless it's 25% off, 30% off, 50% off, people aren't buying it. Anybody going to buy a car? If you need to buy a car today, anybody in this room going to go to a car dealer and pay list price for a car with no rebates or no special incentives right now in today's world? No. Anybody in this room going to go buy a house at whatever the house was worth in 2007? No. Okay, everybody expects a deal on everything. I don't know of any company right now that can actually raise their, that can go, there's so much demand for our services that we're going to raise prices. When the economy starts going back, we'll get into that world. But until that time, inflation is not going to be a problem.
Okay. Well, speaking of mutual funds, we have a lot of questions about the kind of mutual funds to look for now. And if you're new to that, should you wait until a fund has been established a while before you get into it?
Well, I think that's
two separate questions.
Yeah, I do believe that, I know, this isn't even a belief, I know that 20 years from now, the market's going to be substantially higher than it is right now. A lot of people in this room aren't worried about where things are going to be 20 years from now, okay? I want to know where's it going to be a year from now, 2 years from now. Okay, I personally believe that this is a good time to put new money into the market. there's a lot of people who got out of the market, and now they're like, I don't know what to do. I got out, things were low, now they've gone back up. I hate to put my money in because it's higher than when I got out, so I'm going to wait for a good time. I'm going to wait for the right time. Yeah, well, you know, when is the right time? Because if things do go back down, then you're going to go, see, it's going to just keep going down, and you don't put your money in. If things go higher, you go, what the heck? I should have put my money in. We've developed what we call the market reentry plan. It's a systematic, unemotional way of helping people to put their money back into the market. For people who are longer term oriented, I say, you know, go for it, because things right now, I mean, you saw the chart. Yeah, we've had a pretty market recovery from the lows on March 9th, but we still have only recovered about 35% of what the market had lost. So there's still, just to get back to where we were, a lot of upside potential. If you're a little nervous about that, there are systematic ways to do that too.
Okay. Is there a good place you'd recommend for people to go for research so that they know a fund that they're getting into maybe isn't full of Fannie Mae, Freddie Mac, junk bonds, that kind of stuff?
Well, I've said this before, but I believe there's two kinds of people in this world. There's people who have the education, the time, and most importantly, the emotional fortitude to be able to manage their own money. And there's other people that need help. And there are research tools out there like Morningstar.com, which I think Morningstar I don't like their subjective research. Their stars, Morningstar stars mean nothing to me. I don't get it. There's some great funds that have very few stars. There's some terrible funds that have a lot of stars. But if you're just looking at the objective data, they do a really good job of that. And there's forums and discussions. That part's good. If you need help, you need help. And I mean, I'll tell you, God's given me a lot of gifts. Picking mutual funds, I can do that. I can't. Mechanical ability, not so much. I can change light bulbs, and then, but you ever have like you're changing your light bulb, and then like the light bulb breaks, and then like the glass part's in your hand, and the metal part's, yeah, that's when I call the electrician. Sense of direction, not my thing, I do believe that the Lord invented GPS just for me.
It was for me.
Because I call her my girlfriend. You know, she's turn left in 200 yards. Yes, I will. So, anywho, I need help with those things. Some people need help with their investments. It's harder than people think. If there's anything we've learned, it's harder than we all thought. And there's no shame in admitting that you need help. Just like, I mean, my friends, my coworkers, they can tease me about the fact that I can't fix anything. They can tease me about the fact that given an opportunity to turn left or right, I always turn the wrong way. But I admit, you know, there's certain things I'm good at, certain things I'm not. I can't hit a major league curveball. Dang, I'd love to.
Okay, here's a question. What do you think about investing in windmill farms or other sustainable energy?
Yeah. Here's the thing. People, including our Congress and our president, tend to be very reactionary. For those of us who are old enough, anybody remember the Pinto? Ford Pinto. Okay. The Ford Pinto was created. Gremlin, remember that? AMC Gremlin? Cool glass all the way around, could like melt you when you sat in it from the sun. Those cars were created because in 1974 we had the Arab oil embargo, and there were lines at the gasoline stations, and the price of gasoline went, I mean, comparatively speaking, it was like it went from a quarter to 50 cents, you know, it was like, oh my God. And so everybody's like, oh, we want small cars. Okay, then the Arab oil embargo is lifted, price of oil goes back, and people are like, the heck with that, I want a cool, powerful, comfy car. Okay, well right now, there was just an article in the Kansas City Star a few days ago about scooter sales. Like people went out and bought all these scooters, and all these people went and built scooter dealerships, and now they can't sell their scooters because the price of gasoline has gone down again. I believe in a couple things. Number one, I do believe in the ingenuity of science. Okay, I believe that we do need to make cars more efficient. So the scientists will figure out ways to make cars more efficient. We do need to. All right, if we can have power that doesn't pollute as much and costs the same or less, okay, I'm good with that. But I don't believe that human beings have caused all of the woes that a lot of people do. And I do believe, like I said, they're going to figure out ways. Science. Let me give you a perfect. This is my favorite example. When I was a kid, we had 4 channels on the television. Okay, and one of them, you had to spin the dial. Really, he was on UHF. It was a channel 41, 44. It was a long way. Okay, and you had to get up to change the channel. Oh my goodness, my kids, the other day, they were watching something. It was like some infomercial. I'm like, why are you watching this? Well, the remote fell behind the couch, and I don't want to get up and change the channel. I'm like, wow. Yeah. This is how our world has changed. Yeah. Okay, so then they came out with cable TV, and it was the coolest thing ever, and we had 12 channels. First cable TV, telecable, we had in Overland Park. 12 channels, right? Okay, that was cool. Okay, well then, all these new these stations, okay, we want to have all this programming. We want to, and the cable companies, they'd already run this copper cable to your house. And it was really expensive to run the cable to your house. And so if they wanted to put in some other cable so you could get another cable so you could get more channels, it would be really expensive. So what they did was they figured out how to get more channels on the same piece of wire. Okay, so now I have a zillion channels, and there's nothing on any of them, but dude, I'm like channel 3000. I still haven't found anything I want. But the point is, you know, there are ways to get more power, to have the kind of power and acceleration in an automobile that we like, and to have a car of a size that we like, but for those cars to be more fuel efficient. I think we can do that. Windmills, all this stuff. I mean, I just think that it's the kind of thing that people in a reactionary way jump to because people respond to the most recent stimuli that they're given.
So you don't think that's a booming industry that's suddenly going to become the best investment ever?
Not so much.
Okay. Here's somebody who's asking about the amount of time that they have to retirement.
Right.
And if they're going to rebuild their personal wealth, but they have less than 10 years really to do that, is this a good time to get back into mutual funds?
Yeah, well, here's the deal. We had this bear market 2000 through 2002, and that took 3 years, and the market went down 50% during that 3-year period. It took from 2003 through the end of 2007 to get back even. So 3 years to go down, 5 years to get back to even. Okay? In this case, we had the market go down 50% in 9 months. Okay? So I'm guessing that the 9-month kind of thing doesn't take as long to come back as the 3-year kind of thing. So, you know, I think that it is reasonable to expect that the stock market, I mean, if you get a 15% return, we're at low levels. If you got a 15% return, your money would double every 5 years. So 10 years from now, you could be talking about 4 times the amount of money that you have right now.
So it may be fine.
Yeah, absolutely.
Here's a question about IRAs. So if you've got money in traditional IRAs and you want to convert to a Roth, in 2010 specifically, do you have any projections on how long it would take to absorb the tax implications of something
Well, here's
like
the deal. 2010 is a very special year in terms of Roth conversions. Right now, if you have regular IRA money and you want to convert it to a Roth, there are income restrictions. If you make more than X amount of money, you can't do it. And even if you can do it, then you have to pay taxes all in 1 year for making that conversion. In 2010, the income restrictions go away for 1 year, and the federal government will allow you to spread your taxes for 2 years on those gains. I wouldn't wait. If you qualify to do a Roth conversion, I do it right now. And for years, I've said don't do Roth conversions because you're paying taxes now. You're losing out on the compounding on that money that you're going to pay in taxes. With the market as low as it is right now, and with people's values depressed as low as they are right now, it seems to me you do that conversion now, then you're going to get all this growth as the market goes back to where it was, and that's all going to be, then you're never going to have to pay taxes on that money when you take it out. I do think that the older you are, the less, this is the kind of thing you need to talk with your tax preparer about. I gotta be really careful about saying these things, but because you've got to look at your particular situation. You don't want to do a Roth conversion even while things are down. And you don't have to, it's not an all or nothing thing. You can convert part, but you don't want to convert so much of your regular IRA to Roth that you end up putting yourself in a higher tax bracket for all your money or making yourself susceptible to the alternative minimum tax. You got to be careful of those kinds of things. So talk to your tax preparer. But I think this is a really good time to do it now. So because by 2010, what if the market is 20% higher or 30% higher? You could have those. You could make up for the taxes, and in your Roth IRA, and never have to pay taxes on that money ever.
Great. Okay, so say you're going to get a pension plan. You're retiring. Mm-hmm. What's the advantage of doing the lump sum versus the monthly payment, or vice versa?
Okay, it's a mathematical thing, and certainly call us. We'll be happy to help somebody go through the math. But essentially, what happens is if you have a pension, if you're lucky enough to have a pension, because so very few people do these days, what happens is they go, okay, you can either have this amount of money all at once, or we'll pay you this much every month for the rest of your life. And what you have to figure out is, okay, how much return would I have to earn on that lump sum to equal the amount of money that I'm going to get on a monthly basis? And then it gets one step more complicated. See, what happens is they're paying you out every month for the rest of your life. They're hoping you die tomorrow. Okay, the sooner you die, the less they pay out, and they win. So it may be that you need to take some of the money that you're getting in that monthly payout and buy a life insurance policy, so that if you do die, then your heirs, your spouse, etc., will have a new pool of money from which to get income that they're losing because you're gone, whatever the case may be. There's a lot of different options, but it really is a mathematical calculation.
Okay. There's a couple of questions here that really deal with trust. So why does the SEC exist if bad things are happening? Who can we trust? Our banks are failing. Who can we trust? What do you say to that?
I think that there has been a huge destruction of trust in the financial institutions in this country. Our financial system is based on a system of trust. That's what makes the whole thing work. When you buy or sell a stock, stocks have 3-day settlement. What that means is if you buy a stock, you have 3 days to come up with the money to pay for the stock. If you sell a stock, you have 3 days to deliver the stock, whether it be in electronic form or in stock certificate, to the person that bought it. Okay? So there's an assumption that goes on. I pay the money, I get the stock. Okay? Well, part of what happened, the reason that Bear Stearns went down so fast, was they were having all their mortgage-backed security portfolios falling apart, and they would buy a stock for one of their clients, and the other brokers, the contra brokers on the other side, were worried that Bear Stearns wasn't going to come up with their money in 3 days. So they just went, we're not doing business with Bear Stearns, and all of a sudden, Bear Stearns is cut off and they can't function. Okay, same thing has kind of happened with the public. After Bernie Madoff and Alan Stanford and all these things that have come to light. The SEC, the SEC regulates my business. They are in charge of regulation of the mutual fund store and smart401k.com, my other business. So let me just begin answering this question by saying I love the SEC. They may be the most fantastic, coolest people ever.
I don't think any of them are here.
Yeah, but you play it on TV. I was watching, by the way, somebody called me up the other day and they go, hey, flip on channel 17. And I flip it on And there I am, and it was from April of last year, and I was like, God, I have lost so much hair in the last year, and it's gray. So anyhow, but so you do show it. So just in case somebody from the SEC, I love you guys. Okay. That being said, I have problems with what's happened with the SEC because I know that at the mutual fund store, my company, we have had 3 routine audits. So they're supposed to come by periodically and just check on you. Routine audit. Okay. We've had 3 routine audits in the last 6 years. We've come through with flying color. I mean, they find little stuff, but it's all been, immaterial thing, ministerial things. I'll put it that way. Okay. Okay, great. So they've been there, and it's a big hassle, and it's a pain in the neck because it disrupts our business, and we have to produce all. What they do, the way that works is that, like on a Friday afternoon, they will send over a 35-page fax of double-spaced items, all the things they want to see when they show up on Monday. So we spent all weekend, I got all these people, and we're scrambling around, getting all these files ready and everything. Okay, here you go. Okay. Now, how does that happen? They come 3 times in 6 years to us, and we're not, we're doing mutual fund. We can't do front running. We can't. Our client assets are custodied at Schwab Institutional, so the statement comes from a bona fide place, and we have Ernst & Young do our auditing, the second biggest accounting firm in the world, and 3 times. How does Madoff get by? How does he make that happen? I don't know. But that's really what's happening. And so what's happening is that things are swinging the other way. So the government today, President Obama announced these sweeping reforms of the regulatory oversight for the financial services industry, and I will tell you they're being reactionary rather than being proactive. They're like, all these people, Madoff, all these things happen, the banks had these problems, we got to make sure that, well, that's probably not going to happen again anyway, because the banks that are still in business don't ever want that to happen again, and the ones that are out of business are out of business. And if you were going to have a big Ponzi scheme fraud, it probably would have come to light by now with the markets that we've had. So now what they're trying to do is they're trying to prevent the things that have already happened instead of thinking ahead, well, what could happen in the future? It's kind of like after the hurricane Katrina took out New Orleans, they're going, well, maybe we should build, stronger things to keep the water out of the city. Okay, well, they went 200 years. New Orleans is one of the oldest cities in the country. 200 years, no flooding of the city. Now we're going to go, rebuild it bigger, better, stronger. Maybe we should think about what other cities could that happen to, instead of worrying about and that's what's happening is they're thinking backwards instead of thinking forwards. And I love them. They're great. They're fun to hang around. Really cool. Nothing I'd rather do than go to a Royals game with the guys from the SEC. But ultimately, after all said and done, they're being reactionary rather than proactive.
Okay. Here's somebody that asks about some policies that are coming up. Mm-hmm. So if President Obama decided that you as a CEO make too much money, and he decides to replace you with one of his czars, mm-hmm. What would you do and how would you react?
Well...
Hi, President Obama. We love you.
Yeah.
In case you're watching. Sorry.
We do?
No.
Okay. First of all, Switzerland seems cool. I don't want to go to, I don't want to go to one of the, South America or one of the, but Switzerland's cool. They have mountains. They have good food.
Chocolate.
Okay, not my thing, but good for and pretty roads, nice place. I really, I do not. Okay, I'm going to give President Obama the benefit of the doubt. This country is not going to be a socialist country, And you know what's going to happen? If we continued, first of all, General Motors, this is the thing that really pushed everybody over the edge. It's like, okay, we bail out, you know, people thought that the original TARP program was a bailout. It wasn't. It was a liquidity issue. And now, I remember when I talked about this on the radio, I got more hate mail, email, aggravated people calling, going, the government's giving these banks money and they're just bailing out these Wall Street fat cats. And I said, no, these guys are going to pay the government back. They just need liquidity right now. Well, guess what? They're starting to pay them back. That part was cool. It was all good. Now, then, this whole new thing, like General Motors, too big, you can't have that many people unemployed at one time, and it doesn't matter whether they have a good business model or not. You can agree with that or disagree with it. You can say that that was the right thing for the government to do or the wrong thing. But there's not very many companies in this country that have the effect on millions of workers like General Motors did. Because it was General Motors, it was the suppliers, it was the dealers. So even just for the sake of discussion, let's say you agree, you know, it's not like if Blockbuster Video goes out of business that it's too big to fail. There's too many people. So, and what I will say is that if we were to continue to see a socialist type agenda, got to remember there's congressional elections coming up in 2010. There is a presidential election coming up in 2012. There are limits to the power of the president. There are limits to the power of the Congress. And you and I, if we don't like it, we can vote for somebody else.
Thanks. Okay, I think this is going to be our last one. Unless there are more out there. Are there any parts of the economy that you think will never come back, forget it, it's gone? And then what do you think is kind of the brightest spot coming up in the future?
Well, first of all, best and brightest, I believe, is technology. And we're living in the middle of a second industrial revolution. And this country, it's a telecom, it's a communication, and it's not just, you know, we used to think of technology as computers. Okay, that's what people use. Oh, it's Dell, it's Cisco systems. It's not. Technology is affecting us in many different ways. I mean, as I said, we have 28,000 clients, and we're growing. We're according to Wealth Manager magazine, we manage more. We have more clients than any other non-bank investment advisor in the country. It's pretty cool. But that means we got a lot of clients. We have a system that we've invested heavily in that allows us to design a client's portfolio, and then instead of my advisors having to go and manually enter all the trades to rebalance an account the way we used to, they'd have to get out a calculator. Okay, I want 20% in this, and they would have to rebalance it manually. Okay, sell $5,302 of this and buy $5,000. Now we have this technology that we've invested in that we just go rebalance Mr. Jones' account, boom, and it generates the trades. Okay, that has made us much more efficient. We're doing a better job for our clients because we can rebalance more often, more frequently, and we can make changes that we need, and we can do it with less people than we used to be able to do it with. Okay, the same thing is happening. I have a client who is a home builder, and he has several different homes that he's building all at the same time. So the way it used to work is they would deliver a bunch of 2x4s out to a job site, and then they would, when the framers would run out of wood, they would call their boss and say, hey boss, guess what, we're out of 2x4s, and then they would stand around and smoke cigarettes until the truck brought them more 2x4s. Well, now, every morning, the foreman goes by the job site, and he scans in how many 2x4s they got, how many boxes of screws. And so it anticipates how many they need, and they get deliveries every single day, and they never run out. These efficiencies that we're seeing those are going to continue for the foreseeable future, and I like technology a lot. What's not going to come back? I don't know that there's nothing that's completely ruined. Real estate is tough right now, but I mean, I've recently bought some more real estate. I mean, I think that it will come back, and I mean that's going to be the toughest thing. And the biggest problem right now with real estate, and the reason that it'll take the longest to come back, is because the banks don't want to loan money. And so until those lending practices start opening up again, it's going to be tough for real estate to bounce back very much at all.
Okay. Tell us one more time when your radio show plays here locally, and then how can people get in touch with the mutual fund store?
Okay. So locally, I'm on News Radio 980 KMBZ, 10 a.m. on Saturday mornings. By the way, if you came here tonight and you're not a client and you liked what you heard and you want to hear more, we do have an electronic newsletter that we send out to people, and that clients get this stuff anyway. People who are not clients, you can go to mutualfundstore.com, and it says sign up. It says sign up for our email newsletter, and you would click on that, and then you'll get the email newsletter.
That's pretty simple.
I know it's tricky, but
Technology.
what else? Was that the last thing?
I think that was the last thing. And your book is available in the lobby, and they
It
are
is?
autographed.
Yeah,
$10.
They made me sign a lot of books.
Thank you, Adam Bolt, for being here tonight.
Thank you for having me. Can I say thanks to Norm and Elaine one more time?
Absolutely.
All right. Thanks.
Green cards can be handed to your usher on the way out. Don't forget to leave those with us. Thank you for coming tonight. We'll see you on September the 2nd.